Yet another mortgage rate cut from one of Canada's big banks today. It looks like a boon for buyers, but all that cheap money could mask structural problems in Canadian real estate. In January, the Bank of Canada cut its benchmark rate by 25 basis points. Some of Canada's big banks followed suit, cutting key mortgage rates. Today, Bank of Montreal trimmed its special offer on a 5-year fixed-rate mortgage to 2.79%. According to ratesupermarket.ca, that's the lowest ever rate from a major Canadian bank. It remains to be seen whether the other big banks will follow BMO's move. Right now, CIBC's lowest advertised rate for a 5-year fixed mortgage is 4.79%. Royal Bank's lowest advertised rate is 4.74%. Scotiabank offers 4.49%. And TD is touting a 5-year fixed mortgage at 3.09%. Many smaller lenders offer 5-year rates that are even lower. Meanwhile, Bank of Montreal's research division warns almost half of Canada's key housing markets are, quote, very weak. In research out today, BMO Capital Markets economist Robert Kavachik found prices in those 10 key urban areas are falling while supply grows and buyer confidence falters. That certainly isn't the first warning about the state of Canada's housing market. The International Monetary Fund has made specific warnings that this country faces an overheated real estate sector. Hilliard Macbeth is Director of Wealth Management at Richardson GMP and author of When the Bubble Burst, Surviving Canada's Real Estate Crash, and joins me in studio to talk about this. Thank you very much for coming in.
Thank you for inviting me.
Let's start with today's news, I guess, that race to the bottom for mortgage rates continues. For a while there, 2.99 was the line in the sand. It seems now as though there's less opposition from Ottawa as the banks go lower. What do you make of the fact that we're seeing rates this low?
Well, I think it's a sign that the economy is very weak, and that's going to be a problem for Canadians because the big equation is not so much interest rates, it's how much income do people have and what is the price of the houses that they're buying. So in Alberta, for instance, a few months ago, people were being offered up to $1 million in mortgage debt. Young couples that I met myself with, say, $200,000 in family income, which obviously is higher than normal, we're actually being offered $1 million in mortgage debt. And, it's to me, it's crazy.
Yeah, certainly when you hear a story like that, particularly in a place like Calgary, where we know the economy can and has turned on a dime, it's not surprising that there are so many people out there who believe that the real estate market is in a bubble. Let's start with sort of your parameters. How big a bubble do you think it is, and how imminent is collapse?
Well, in Canada, we've had, in my experience, 3 bubbles, one in the early 80s, one in the early 90s, and then this one. Now, this one's much, much bigger than the earlier 2. And the Bank of Canada, I think, and CMHC have recognized that although they don't like to say the word bubble, there was a report that came out and said that housing was 10 to 30% overvalued. But in my work that I did, I'm looking at more like a 40 to 50% overvaluation. So, and that would get us back to the trend line that existed before this bubble started.
If you're right, because that's a fairly catastrophic, we'll say it's at the negative end of the ranges that I've seen. If you're right and we talk about a 40% correction, what does that mean in terms of the numbers of people that might have negative equity in their home, or just the damage that could do to the economy?
Well, I think the economy is vulnerable because in Canada, about 7% of the GDP is investment in residential real estate, and that's very high. The past, it's been 5 to 6% maximum. This is the first time we've ever gotten to 7%. In the U.S., which is a really good comparison, they peaked out at 6% of GDP. Before, in the crisis and the recession that followed 2009, it dropped down to 2%, and now it's rebounded back to 3.5%. So that's a lot of people that are working in construction, a lot of people that are investing in homes, and that has to correct. It has to probably go back to 3%.
Are you worried about the banks, given that prognosis? Do you think they adequately are prepared for that kind of risk?
Well, the way the banks work, it's an interesting question.
Or the taxpayers, maybe we should.
Yeah, exactly. The CMHC, about 3/4 of the mortgages outstanding in Canada have some kind of insurance on them, whether through the CMHC or 2 other private lenders.
Right.
But all of them are guaranteed by the Government of Canada. So the CMHC itself has very, very minimal reserves, about 5% of their insurance outstanding. So in a correction like 40 or even 30% in housing, the CMHC would quickly run out of reserves, and then the Government of Canada would get involved. I'm sure the Government of Canada will make sure the CMHC survives.
Solvent, right.
And as I mentioned in the book, the banks will survive. but they will go through some difficulties because because of the way the CMHC works with the banks, they're not required to keep much in the way of reserves at all against those type of mortgages.
But a double whammy for consumers because you get hit on the taxpayer front as well. Okay. Buying opportunities. Let's try to look at the bright side here. If you're right and we're headed for this kind of a correction, is this a situation where you could see the buying opportunity of a lifetime? Because obviously there are a lot of people, especially young people, who have been squeezed out of the market, that housing is just unaffordable right now.
Yes, well, the survival techniques that I suggest are renting instead of buying until this is sort of worked its way through the system. Now, one of the mistakes that people will make is they'll buy too early, because this is probably like it was after the 1980 crisis and the 1990 crisis. It's probably more like a 10-year deal rather than a 2-year deal. So
you mean a 10-year to recover back to where they? Okay.
Yeah, and so unless somebody absolutely needs to buy a house, renting is perfectly fine, and then the money could be invested in what will probably be an extraordinarily cheap stock market, which is where the real opportunities, I argue, are going to be. The
problem, of course, is all those people who have been sitting on the sidelines waiting for the collapse, and they still wait, and then they see prices keep climbing, and they feel like they should have bought 2 years ago. Do you have a time prognosis for when you think this collapse is going to happen?
Well, I was looking at some correlations today between the price of oil and Toronto real estate, and it turns out it isn't just Calgary and Edmonton real estate that are correlated with the price of oil. It's actually all across Canada. So now that the price of oil has dropped from $100 down to $44 or $43, I would expect that will start to at least cause a mild correction, if not the bursting of the bubble that I'm predicting.
All right. Hilliard Macbeth, thank you very much.
Thank you.